Your due diligence didn't fail. The fraud was designed to pass it. 22 people were just arrested by the NBI for running a coordinated investment fraud scheme in Makati City. Investors lost everything they put in. And they weren't careless. They came from different backgrounds. They applied normal scrutiny. The operation was calibrated to clear the checks careful people run. Therefore, the protection you think you have may not be the protection you actually need. Here's the case. The NBI, the Philippines National Bureau of Investigation, executed a coordinated enforcement sweep and arrested 22 individuals operating a large-scale investment fraud scheme on March 30, 2026, in Makati City. Investors transferred funds based on documented return promises. The money was absorbed into the operation. The structure used here is not unique to this jurisdiction. Fraudulent trading platforms using fabricated account data have been documented in enforcement actions globally. The NBI action is the evidence surface. The pattern is global. Therefore, the question is not what happened in this case. The question is what mechanism made it possible, because that mechanism is not unique to this operation. Investment fraud operations like this one follow a recognizable pattern. Step 1. Establish credibility. The operation ran through what appeared to be a legitimate online trading platform. Victims were given login pages. They could see their account balances. They could see their profits growing. None of it was real. The profit indicators were fabricated. The account balances were manipulated. The platform existed to create the appearance of returns, not to generate them. Step 2. Induce more capital. Once victims believed the platform was working, they were encouraged to deposit more. Some recruited others. The fake data did the convincing. Step 3. Early investors get paid using later investors' money. This creates social proof. Real people telling real contacts it's working, and here is where the operation gains its most important asset, deniability. Early investors are not actors. They are genuine believers. When they recruit honestly. Their conviction is the product. The fraud doesn't need to lie to them. It already paid them. Step 4. Scale. Recruit more investors, collect more funds, delay withdrawals. Step 5. Exit or collapse. The operators either disappear, get arrested, or the structure implodes when new money stops flowing. The NBI arrested 22 individuals at Step 5, but the pattern that enabled it started at Step 1. And here's what most people miss. You can be targeted at any step. Not just the last one. The danger isn't the collapse, the danger is the design. But knowing the design is not enough protection, because this operation did not reach its victims through cold outreach. Therefore, the mechanism had a second layer, and that layer is the one that actually bypassed expert-level scrutiny. Fraud operations at this scale don't penetrate cold. They penetrate through trusted deal flow. A contact in your professional network surfaces an opportunity. Someone with credentials you've verified in other contexts is involved. The social proof is embedded in the referral chain itself. That's the exploit. Your network has already done the filtering. So you process the offer at a lower skepticism threshold than a cold pitch would receive. The NBI case shows the operation reached victims through coordinated outreach, not random targeting. Victims weren't isolated targets. They were nodes in a connected system that was mapped and recruited deliberately. The attack surface wasn't their financial knowledge. It was their trust in the counterparties who reached them. Therefore, the obvious conclusion is, be more skeptical of your network. But the NBI evidence breaks that conclusion immediately, because the victims were skeptical. They applied normal scrutiny, and they still transferred funds. Let's stop here, because at this point most people watching think, this doesn't apply to me. I'm careful. I research things. I don't invest in things I don't understand. That's the correct instinct, but here's what the NBI case reveals that changes the calculation. The victims in this operation weren't financially unsophisticated. They came from different backgrounds. They applied normal scrutiny. They didn't fail because they were careless. They failed because the fraud was calibrated to pass the exact checks careful people run. That's a different problem, and it requires a different solution. So what do careful people miss? 3 things. First, documentation without verification. A legitimate-looking document is not a verified document. Fraud operations produce professional materials because professional materials are cheap to produce. In this case, login pages, account dashboards, profit statements, all of it fabricated. All of it convincing. Second, performance without auditing. Early returns are evidence of payment, not evidence of a legitimate business. The scheme survives on the gap between those 2 things. Third, authority without accountability. Someone presenting as a financial professional, a licensed broker, a registered company. None of that guarantees regulatory oversight of the specific offer being made. These 3 gaps, documentation, performance, authority, are where investment fraud lives. The 22 individuals arrested by the NBI exploited all 3, and regulatory filings don't close these gaps. Only independent verification does. Therefore, the protection isn't trustless. The protection is verified differently. Now here's the part most coverage of this story missed. In enforcement actions of this type, asset recovery is structurally constrained. What was seized, what was traceable, and how long the scheme ran before investigators moved. These determine what victims can recover. Therefore, in most cases at this scale, the arrest is not a remedy. It is a consequence for the operators, not a resolution for the victims. For many people in this operation, the arrest is the end of the story. The money doesn't come back. That changes how you need to think about protection, because after the fact is too late. So what does protection actually look like? Not general skepticism. Specific verification. Before you place capital anywhere, 3 checks. First, independent regulatory confirmation, not the document they give you, the actual regulator's public registry. In the Philippines, that's the SEC, the same regulator the NBI coordinates with on cases like this one. In the U.S., the equivalent registries are FINRA BrokerCheck and SEC EDGAR. You check the entity, the individual, and the specific product separately. If the offer isn't in the registry, the offer isn't regulated. That is not a technicality. That is the entire exposure. Second, structural red flags. Any investment that requires you to recruit others to earn returns is not an investment. It is a recruitment scheme dressed as one. Any investment where withdrawal is conditional on timing, volume, or lockup periods that weren't disclosed up front. Flag it. Any investment where you cannot independently verify where your money is held, stop. Each of those conditions exists to delay the moment you discover the money is gone. Third, trust network audit. If someone in your professional network referred you to an investment, that referral is a relationship signal, not a verification signal. You still run checks 1 and 2. The NBI case shows why. The people who recruited victims believed in the operation. Their belief was real. The operation was not. The NBI arrests didn't protect the victims. The only thing that would have protected them was verification before transfer, and verification takes less time than recovering from fraud. 22 people were arrested. That number matters because it confirms this wasn't a one-person operation. It was structured, it was coordinated, and it was running long enough to scale. The arrests are real, the losses are real, and the pattern that produced both is not unique to this case. It is the same architecture used in investment fraud operations globally, which means the risk didn't end with the arrests. It resets with the next offer. ScamBeast analyzes corporate fraud patterns and governance failures using primary regulatory sources. If you work in finance, tech, or leadership, follow ScamBeast. Full sources and documentation are in the description. The next episode covers how fraud operators use professional credentials as cover and what the specific tells are that give them away. Stay analytical.